credit sales where you are paid after more than 1 year. Folks, keep an eye on Eddie. He might enter any time. Let me know. Pamela, yep. See, think of devil and devil is here, but he is very quiet devil. He never speaks. It took me 2 weeks to understand that he's a boy. Okay. Right. Now, credit sales where you get paid after more than 1 year. Right. Normally, when we record credit sales, we record receivables. And technically and theoretically, receivables should be received within 12 months. Right. That's why we do not charge any interest on them. And we do not take the present value because they are less than 12 months. But if we are making a sale and the sale is for more than 12 months, that means this is overdue and too long. Now our finances will get stuck. And for more than 1 year, we will have to finance business out of our own pocket. Right? So that will cost. So finance component will be there, financing component will be there. Whenever you have to wait for more than 12 months, as a businessman, right, it is going to cost you and you are going to charge more. So if I sell it for 6 months credit, I will charge 10,000 for example. But if I am selling for 1.5 years credit, then I will charge 10,000. I will charge more. So the standard wants you to distinguish between what is the price of waiting and what is the price of goods, right? So standard says if you wait for more than 12 months, then revenue or price of goods will be the present value. Right? If you have to wait for more than 1 year, then you will have to distinguish between the revenue, that is price of goods, and price for waiting. The present value will be your revenue, right? And unwinding, which we'll do in a minute, will be actually your interest revenue. That will not be price for goods, but that will be price for waiting interest, right? Okay. So let's get to test your understanding one, Red Company. Now it says the Red Company enters into a contract with the customer to sell equipment on 31st December X1. Control of the equipment transfers to the customer on that day. So our sale is completed on 31st December X1. The price stated in the contract is 1 million and is due on 31st December X3. That means after 2 years. That means 1 million includes price of goods and price for waiting. Right, so we will have to, it's test your understanding one visual on page number 250. 250 of the book. Textbook we are doing. Captain. There, Rachel. Okay, thanks. There she comes. Upgrade her. Good morning, afternoon, evening, Pamela, whichever is applicable to you. Right, okay then. So you see, we have 2 years. So our sales made now, after 1 year, 2 years. It's 31st December. X1 when the sale is made. Right, when the sale is made. 31st December X2 next year. And when money will be paid, 31st December X3. Right. We will be paid 1 million on 31st December X3. Now it is 2 years after the sale. 2 years after the risk and rewards were transferred. Right. That means it has to be distributed whenever it goes 12 months. It has to be distributed between price of goods and price of waiting. So it's 10% interest. We take the present value of 1.1, 10%. Okay, can someone calculate it for me, please? Can someone calculate it for me? We will get 1 million after 2 years. So we have to take the present value. So 2 years discount factor will be used. Can someone use the calculator? Please be quick. Hell no, Samantha. Hell no. Yep. 826446. Right, that is revenue. That will be recorded as revenue today. That is price of goods. Right, that is our revenue. Right. So now we will see what is the price of waiting. Now this is called winding up. Now we will unwinding like provision. Right, now we will unwind it. 826446 and 2.10 discount factor. That gives us 82644. So what will be the liability on this date? If you add them to 82446 plus 82644, how much it is? Yes. Yeah, it has to be divided. The divide sign is clear. Okay, can you add them to, please? 826446 plus 82644. No, at least you divide them, take the present value. Simple discount factor. 1 million divided by 1.1 raised to power 2. Okay. So this gives us 9090910. Right. So this is receivable at the end of the year. This is our receivable. Okay. 909090 into 0.1, 10% again. That gives us 90909. Right. So this takes us to 1 million. That will be received after 2 years. Right. This is called interest revenue. It is not your revenue from goods, but it's revenue from your price of waiting. Interest revenue. That is 82644 will be recorded in first year as interest revenue, and 90909 will be recorded as interest revenue of second year. So all you need to be cautious about is whenever you get paid after more than 12 months, a price of waiting will be charged. There will be a financing component. That will be called interest rate. So if we get money today, we will sell it for 826,446. That is the price of goods. Right, understood, all of you? Can we move ahead? Please give me go ahead. Samantha, Edis, Rachel. Both Rachel, Eddie. Okay. Yes. Okay. Okay. It's book. Rachel, present its book. Okay, I'll go over it again. Okay. Now, Rachel, you have to think as a businessman. You are selling your goods, right? You are selling your goods, and the customer say it will pay you within 6 months. That is fine. That is no financing charge, no value will be lost. That means normal receivables. But if the customer say, sell me the goods today, and he or she will pay you after 1.5 years or after 2 years or 1 year, that means for 1 year you will have to wait for the money to come. That means now inflation has its impact. So now you will charge extra. You will not charge only price of goods, but you will charge the price for waiting as well. Because all those years until he pays, you have to run business out of your own pocket. So it will cost, and you will recover that cost. So what you do, as soon as it crosses 1 year mark, you take the present value. The present value is what you will charge if you receive the money today. That is 826,446. But he will pay you 1 million after 2 years. So the price of goods, actual price is 826,446. The extra bit is price for waiting. You have increased the price because you were made to wait. Right? So you have taken the present value, winded up value. And now you will see how much is the price for waiting. So you will charge interest on that amount, 826,446. You will unwind it. First year 10%, 826,444 is price of waiting for 1 year. And next year, the total receivable at the end will be 909090, including price of goods and price of waiting for 1 year. Next year, you will wait for 1 more year. So you will charge more. So you will charge 10% of receivables at the end of year 1, 909. So then you will receive 1 million, out of which 826,446 is price of goods and rest is price of waiting over 2 years. You got it, Rachel? Okay, our very own Rachel. See, it's good. I think you are concentrating more on songs rather than what is going on the book. Yeah, it is. Your equation is right. But if you multiply it, when you multiply it, you get -2. When you divide it, you get 2. Yes, Rachel, anyone can tell it. You are concentrating more on songs. You enjoyed more songs than teaching. Am I right, Addis? Am I right, Addis? Okay, Addis is not replying, so we go on studies. We go back to studies. Leave it, Addis. It has lost its charm now. Oh, Rachel, we believe you. Don't worry. Please don't leave it. Don't leave the class. Okay, we move ahead. Please take the screenshots. I'm going to remove it. Please take the screenshots. Addis, you gave up so early. I didn't expect this from you. You are a fighter. Okay, take the screenshots. We are moving ahead. Okay. Okay, now we are doing payment made to customer, the next concept. Right, we are doing this concept, payments made to customer. Right. Let's draw this concept. Right, okay. right? A made sales to B of $1 million, right? So A recorded receivable of 1 million, right? Natural. A will record receivable 1 million from B. Okay, B is the customer and A is the seller. So A has the receivable of 1 million. That is to be received from B. Right? Okay. Now let's suppose A pays B $100,000. Right? This is called payments made to customer. You are selling to customer, you are supposed to receive money from customer. But for any reason, if you are making payment or you have to make payment to B of 1 million, now what is the status of your total receivable? Will your receivable and revenue will be 900,000 or 1 million, right? So the question is whether revenue will be shown as gross or net. This is the question. This is the concept. You have to receive 1 million from B, right? And you have also to make payment to B. Now, will you show your revenue and receivable as a net figure or as a gross figure? Okay. Now we answer this question. The answer is if A purchased identifiable goods or services from B, then both transactions will be recorded separately. Right? That says that if it is evident, clear that B sold identifiable goods like computers. You know what did they sell? Computers, etc. Right? That means now B will record receivable of 100,000. Right? Both transactions will be dealt with separately. No netting. It will not be netted off. Right? Both transactions will be recorded separately. As long as the payment to customer is made for identifiable goods. It is mentioned that what did you purchase? And if it is not mentioned, that why are you paying? Right? If it is not mentioned as to why the payment is being made, then netting off. Then you will do the netting. right? So if you are not paying for separately identifiable or distinct goods or services, it is not known why are you paying customer, then you will net it off. It will be treated as discount and you will net it off. Okay, did you all get this principle? Our very own Rachel Brizan, Ade, Samantha, Ade. Addis, did you get this? Addis, waiting for your reply. Uh-oh. I'll share the recording. Right. Samantha will explain it to you. The princess has to take the responsibility. Okay. Okay, take the screenshots, please. We are going to do a numerical example now. That's fine, Addis. It happens. Okay, we'll be doing illustration 4 now. Okay. Illustration 4, the same page, number 250 of the book, Rachel. Okay, it says Golden Gate Company enters into contract with a major chain of retail stores. Customer commits to buy at least 20 million of products over the next 12 months. Terms of the contract require Golden Gate Company to make a payment of 1 million to compensate the customer for changes that it will need to make to its retail stores to accommodate the products. By 31st December X1, Golden Gate has retained transfer products with a sales value of 4 million to customers. Right. Okay. So total sales to be made are, whiteboard please, are 20, right? 20 million. And 1 million will be paid to customer. $1 million will be paid to customer. Now we have to see, do we net it off or do we record it separately? Now, what are we paying 1 million for? Just to accommodate our own products. That means there is no separate service or product. Service or product is being received. So it will be netted off. No separate goods or services being received. All they are doing is making the space for our product in their retail store. Right, it will be net. So it will be netted. So total revenue will be will be 19 million. Right. In percentage, 1 by 20 is being netted off. How much it is? It's 5%. 5% is being netted off. So 95% will be recorded. Okay. Total sales so far are 4 million. So revenue will be 4 into 0.95. How much it is? How much it is? 3.8 is the revenue. right? We will net them off because the payment is being made not for any distinct goods, but simply just to accommodate the sale like discount. So 3.8 is the revenue. All right, that is it for today. Take the screenshots, please. Okay.